I'm Alan Kenny, and I'm in Dallas for NAREIT's REIT World. I'm joined by Stephen Marks, Managing Director with Fitch Ratings. So, Stephen, what kind of trends are we seeing right now in REIT bank borrowing exposures?
It's actually one of the few things that we're concerned about when it comes to REIT liquidity and access to capital, which is when you look at the sum of bank borrowings, which is drawn lines and term loans relative to the overall debt capital structure, it's close to near sector highs. At the bottom of the cycle back in 08-09 it was around 8%, now it's around 18%. And we understand why that ratio is higher now than it was a few years ago. One is that companies are really looking for this source of capital. They're looking to find ways to pick up a penny or two on per share growth. And so in an environment where there are really low cap rates, so it's hard to buy things accretively, development pipelines are lower now than they were back in the previous cycle. Same store NOI growth is 2, 3, 4%. It's hard to find that organic growth. So companies, instead of doing, say, 10-year bond deals, are instead doing 5 to 7-year term loans, which are cheaper. So we understand why companies want it. The banks like pushing out this form of capital because it's funded capital, so it helps them from a capital standpoint on their ratios. So we understand the push and pull, but it does create an issue for us when we think about broader access to capital, to the extent that there is perhaps a liquidity crisis or a point where companies need to reach out to the banks for incremental capital and the banks are full up. That could be an issue as it relates to access to capital and broader liquidity concerns.
And how does asset financeability impact your ratings of REITs?
If you think about the various asset classes, the core ones that have pretty good financeability, multifamily, office, industrial, retail, and some forms of healthcare, generally those companies are investment grade or can be investment grade because there is a fairly robust mortgage market, whether it be banks, CMBS, insurance companies, or in the case of multifamily and some forms of healthcare, the GSEs. So which is one of the reasons why multifamily REITs can be levered fairly high for a given rating category relative to other retail, relative to other asset classes, is because they do have this contingent liquidity, this access to this alternative form of capital that a lot of other real estate companies and certainly a lot of other corporates don't have. So in a situation where a REIT owns assets that are just really not that financeable in the insurance company, for instance, the insurance company mortgage market, hospitals, prisons, copper fiber networks, there's not a robust mortgage market for those asset classes. And so in those cases, we tend to look at those REITs more through the lens of a traditional corporate industrial widget maker, service provider, where the leverage needs to be relatively lower for a given rating category, whereas some other asset classes that have good contingent liquidity, they're able to get a mortgage on an asset. It's kind of a break in case of emergency, unencumbered pool, in case you have to get a mortgage on a set of assets to repay an upcoming bond maturity to avoid a default. It's why if you have good contingent liquidity from your assets via mortgages, you can have higher ratings or higher leverage at a given rating category.
And lastly, 2018 is coming up. What are you going to be watching?
Yeah, we are close to the end of 17, heading into 18. A few things we're focused on are fundamentals. Generally, broadly, as a broad theme across most asset classes, we still think there will be positive same-store growth and good occupancy levels. Generally, the one or a couple of places where we're a little more concerned on the fundamentals are in retail. It's unclear, for instance, for the B malls or more challenged retail formats, to what extent where the bottom is on some of the fundamentals. There's been some fairly negative trends that have been occurring in the B mall space around leasing stats and tenant retention and things like that we're a little more concerned about for retail. Where where the locations perhaps aren't as strong or as robust and the demographics aren't as good. And the other place on the fundamental side that we're more concerned about is skilled nursing. The underlying operators have had some concerns around reimbursement rates and overall profitability. So I'd say those are the two areas of focus, more of a concern. The rest of the sector, more broadly, we're not too concerned about.
Well, Stephen, thank you so much for your time.
Yeah, thank you, Alan.
For more real estate news and analysis, be sure to visit NAREIT's website, REIT.com.